You know that big tech company, the one whose phone is in your pocket right now? Last year, they reported billions in profit globally, and they paid an effective tax rate of close to zero. Not because they broke the law, because they wrote the rules, the game is rigged. It's not just about finding a small loophole. It's about a global system that allows the richest, most profitable companies on the planet to legally sidestep almost every tax requirement a normal business or a normal person has to follow. This is not a mistake in the system. This is the system. And it is costing governments around the world hundreds of billions of dollars every single year money that should be funding your roads, your hospitals, and your schools. Today, we're going inside the global tax avoidance game to uncover how the biggest multinationals on Earth achieve the impossible, paying absolutely nothing. Look around your city. Think about the small businesses, the local coffee shop, the hardware store, the family bakery. They pay their local taxes, state taxes, and federal taxes. Their effective tax rate, the real percentage of their profit they hand over to the government, is usually exactly what the law says it should be, somewhere between 20 and 35%, depending on where they are. Now, imagine a company that makes more money in a week than all those small businesses combined make in a year. The headline tax rate is the same for them, maybe 25% or 30%. But the number they actually pay is closer to 3%. Sometimes it's literally $0. This huge gap between what the law says they should pay and what they actually pay is the fatal flaw at the heart of the global economy. It creates a crisis of legitimacy. When normal people see a small business owner struggling to pay their fair share while a tech giant is swimming in cash tax-free, they stop trusting the entire system. The core reason this is possible is simple. Money is mobile, but tax laws are not. If you own a single bakery, your money is made and taxed right there in that one location. But if you are a multinational corporation, you can have your headquarters in Delaware, your manufacturing in China, your sales in Germany, and critically your intellectual property, your patents, and your brand name in a tiny low-tax country like Ireland or the Cayman Islands. And this is where the magic or the scam happens. They exploit the simple fact that every single country in the world is desperate for foreign investment. They are all caught in a never-ending, self-destructive race to the bottom, where they cut their corporate tax rate lower and lower, hoping to win the prize of having a major company set up an office, even if that office is just a mailbox on a shelf. The moment one country lowers the rate, every other country is doomed to follow or lose business. This entire global setup means that a company can simply move its profits out of the high-tax country, like the US, France, or Germany, and shift them into the low-tax country, like Bermuda or the Netherlands. And they do this using three main tricks. This is the most famous, most lucrative trick in the entire global tax avoidance playbook. It was largely perfected by major American tech companies and pharmaceutical giants, and it relies on something called intellectual property, or IP. What is a company's IP? It's the core value. For a pharmaceutical company, it's the drug formula. For a tech company, it's the software code, the patents, the logos, and the brand name. This IP is what actually generates all the profit. So, here's how the trick works. Specifically the setup famously known as the double Irish with a Dutch sandwich, a name that sounds cute but caused an economic crisis in tax collection worldwide. Step 1. Setting up the shell. The multinational company creates two separate subsidiaries in Ireland. Irish Company 1. The boss. This company is the official legal owner of all the valuable IP, the patents, the code, the trademarks. Critically, this company is incorporated in Ireland, but it is managed from a tax haven like the Cayman Islands or Bermuda, meaning it doesn't have to pay Irish taxes. Irish Company 2, the seller. This is the Irish-based company that actually sells the product to customers across Europe. This is the company that makes the money. Step 2, the invisible bill. A customer in Germany or France buys an app, a piece of software, or a drug. The money goes to Irish Company 2, the seller. This is where the profit should be taxed. But Irish Company 2 needs the intellectual property, the patent for the drug, or the code for the software to sell the product. So, Irish Company 2 is forced to pay a massive prearranged royalty fee to Irish Company 1, the boss, for the use of the IP. This royalty fee is often engineered to be exactly as high as the sales profit. If the company made $100 million in profit in Germany, Irish Company 2 pays $99 million to Irish Company 1. The effect is instant. Irish Company 2's profit is instantly reduced from $100 million to $1 million. The country where the money was made, Germany, France, now has almost nothing to tax. Step 3. The Dutch sandwich. But wait, now the $99 million is sitting in Irish Company 1. If Irish Company 1 sent that money straight to Bermuda, the Irish government would impose a withholding tax on the transfer. That's a small but annoying fee they want to avoid. Enter the Netherlands, where the tax laws are different. The $99 million is first routed through a Dutch holding company, the Sandwich. The Netherlands does not charge a withholding tax on money being moved to other EU countries or on money being moved to places like Bermuda. The money pauses in the Netherlands for a day, avoiding the Irish withholding tax, then continues on its journey. Step 4. Zero tax achieved. The $99 million finally lands in Bermuda or the Cayman Islands or some other traditional tax haven where the corporate tax rate is a blissful, beautiful 0%. The end result? The company's profit went from a high-tax country through a low-tax country, Ireland, through a zero-tax highway, the Netherlands, and into a zero-tax haven, Bermuda. The company has successfully paid $0 in tax on billions in profit. The double Irish was finally banned by the EU in 2020, but not before it allowed companies to shift trillions of dollars over 2 decades. And did the companies panic? No, they simply moved on to the next strategy. This is why the fight against tax avoidance is a never-ending game of whack-a-mole. Every time a loophole is closed, 10 more pop up to replace it. The very structure of international finance is designed to be exploited this way. If the IP trick is about paying for invisible product software code, the second major trick is about paying for an invisible service, interest. This trick is called debt shifting, and it's arguably even harder to track. This whole system relies on the fact that when a business borrows money from a bank, the interest payments on that loan are considered a cost of doing business and are therefore tax deductible. Every company is allowed to subtract its interest expenses from its profits before calculating its taxes. The multinational company takes this simple, sensible rule and uses it to weaponize its internal structure. Step 1. The internal bank. The company establishes an internal bank or financing arm in another tax-friendly country, let's say Switzerland. The Swiss subsidiary is then flush with cash, either from years of previous tax avoidance or from the company's main profits. Step 2. The fictional loan. The parent company is highly profitable German or French subsidiary, the one that needs to reduce its taxes, doesn't go to a real bank for a loan. Instead, it borrows a massive amount of money, say $1 billion, from its own Swiss subsidiary. This is not a real loan where an outside bank expects you to pay it back. It's just money shuffling from one part of the company to another part of the company. It's totally fake, but it's legally written down as a debt. Step 3. Generating the tax deduction. The German subsidiary is now required to pay interest on that $1 billion loan back to the Swiss subsidiary. This is the key. Let's say the German subsidiary makes $100 million in profit, and the interest payment on the fake internal loan is $90 million. In Germany, high-tax country, the subsidiary declares $100 million in profit, but deducts $90 million in interest expenses. Its taxable profit is now just $10 million. Germany loses the tax on $90 million. In Switzerland, low-tax country, the Swiss subsidiary receives the $90 million interest payment. Because of Switzerland's low corporate tax rate, especially on passive income like this, the company pays a tiny amount of tax on that $90 million. The multinational has successfully shifted $90 million in profit out of a high-tax jurisdiction, Germany, and into a low-tax jurisdiction, Switzerland, all by writing a fictional check from one pocket of its corporate pants to the other. This is a classic example of transfer pricing abuse. Transfer pricing is the process of setting a price for goods or services sold between two different related parts of the same company. If the German subsidiary sells a car part to the American subsidiary, what price should they set? They can set an artificially low price to keep the profit out of the high-tax country. Or, in the case of the loan, they can set an artificially high interest rate to pump the expense into the high-tax country. The biggest issue for tax collectors is that these internal interest rates are incredibly difficult to audit. The company can argue that its internal loan interest rate is at arm's length, the same rate a real bank would charge. But who can prove otherwise? The money is never seen by a third party. This creates a massive, multi-billion-dollar gray area that tax authorities simply cannot keep up with, leading to billions in lost revenue, a true fiscal crisis. This is where the economics stops being abstract and starts hitting your life directly. When a company like Apple or Pfizer avoids $10 billion in taxes, that money doesn't just vanish into thin air. It's $10 billion that your government or the French government or the Japanese government no longer has. Imagine $10 billion. In the United States, that could cover the annual cost of the entire Head Start program for underprivileged children. With billions left over, in a smaller country that could rebuild every major highway, pay for thousands of nurses and teachers, or fund a decade of climate change research. When that money disappears, governments have only two choices: cut services. They reduce spending on public services like healthcare, education, or infrastructure. The quality of your life slowly degrades. Roads get worse, school class sizes get bigger, and medical waiting lists get longer. Raise taxes on you. The government must find the missing revenue somewhere, so they raise property taxes, sales taxes, or income taxes on the working class and small businesses, the people and entities that cannot afford to hire the armies of lawyers and accountants who devise these loopholes. This is the great injustice of the tax avoidance game. The poor subsidize the rich. The tax burden is perfectly shifted away from multinational corporations and onto the shoulders of ordinary people and small domestic businesses. The first massive moment of clarity on this issue was the 2008 financial crisis. When governments around the world had to bail out banks and stimulate the economy, they suddenly needed every single penny of tax revenue they could find. This desperation focused a bright spotlight on corporate tax avoidance for the first time. The media, activists, and finally, politicians realized the scale of the theft was not billions but trillions of dollars over decades. This revelation, born from an unprecedented financial collapse, forced the world's most powerful economies to finally admit that the system was broken. The old, country-by-country tax rules were completely doomed in the face of the modern, borderless digital economy. It was a crisis that demanded a radical global fix. For years, the political establishment was paralyzed. Every country wanted to stop the avoidance, but no one wanted to be the first to raise their tax rate and risk losing the minimal business they did attract from the multinationals. But in 2021, the world finally agreed on something huge, a global deal led by the OECD, a club of rich countries, called the Global Minimum Corporate Tax, or Pillar 2. The rule is incredibly simple, and it changes everything. No matter where a multinational company operates, it must pay an effective tax rate of at least 15% on its profits. Think back to the $0 tax payment by the tech giant. This new rule is designed to stop that permanently. Here's how it works. If an American multinational makes a profit in Ireland and only pays 5% tax there because of the loopholes, the U.S. government is now legally allowed to step in and apply a top-up tax to bring that total tax payment up to the 15% minimum. Suddenly, the reason to move profit to a country with a 5% rate vanishes. Why bother with the complexity, the lawyers, and the risk when your home country is just going to collect the difference anyway? This is a monumental agreement. It has been signed by over 140 countries, meaning almost every single economy on Earth has agreed to stop the race to the bottom. It kills the IP shifting trick and the debt shifting trick in one decisive blow. But the fight is far from over. Small tax haven countries like Ireland, Hungary, and others are naturally furious. They built their entire economy around offering low rates, and now that business model is doomed. They are fighting tooth and nail to delay, water down, or find new exemptions to the rule. Furthermore, it relies on major powers like the United States and the European Union actually implementing the complicated new laws. Getting 140 governments to agree is one thing. Getting them to actually pass the legislation is another. The game has simply shifted from finding loopholes to finding ways to slow down or outright sabotage the implementation of the new law. The biggest companies in the world are still spending hundreds of millions on lobbying to preserve their tax-free profits. They know this 15% minimum means potentially billions in new annual tax bills. The battle is being fought right now in the backrooms of Washington, D.C., Brussels, and Dublin. The success of the global minimum tax will determine whether governments can truly fund the future, or whether the burden of a modern economy will permanently remain shifted onto the people who can afford it the least. The game is rigged, but for the first time in decades, the global community has decided to try and change the rules. It is the biggest economic battle of our generation. The global system allowed the richest companies to hide trillions. That money should have built your hospitals, roads, and schools. Now, the battle to reclaim it is finally underway. If you want to see which country will be the next to face an economic collapse because of these tax tricks, subscribe for more.